Let me ask you a question. Imagine two friends. Both are 30 years old. Both make exactly $90,000 a year. One buys a house, the other rents. Fast forward 30 years. Who becomes wealthier? If you immediately said the homeowner, you might be right. Or you might be completely wrong. Because despite what social media tells you, buying a house does not automatically make you rich, and renting does not automatically keep you poor. Welcome to GoPo. Today, we're going to destroy one of the biggest financial myths ever created, the idea that renting is simply throwing money away. We're going to look at the actual math, the phantom costs nobody warns you about, and the secret wealth equation that determines who actually comes out on top. By the end of this episode, you will know exactly which choice makes sense for your life. I love reading comments whenever someone talks about housing online. Someone always says, renting is throwing money away. Then another person replies, no, buying is throwing money away because of interest. Then someone jumps in with property taxes, then maintenance. Before you know it, three strangers are arguing on the internet while real estate apps quietly raise their prices again. But they are all focusing on the wrong question. The real question is, which decision helps you build more wealth over the next 20 or 30 years? Let's get the biggest cliché out of the way first. You will never see your rent money again. It sounds logical, right? But let's apply that same logic somewhere else. You buy groceries, you eat them, the money is gone. Was it wasted? You pay for internet, you use it, the money is gone. Was it wasted? You buy insurance, hopefully you never use it. Was it wasted? Of course not. You paid for something valuable. Rent works the exact same way. You are paying for shelter, security, flexibility, and predictable monthly costs. None of those things are free. Renting isn't throwing money away. It is buying a service. The real question is whether that service is worth the price. Sometimes it absolutely is. Sometimes not at all. But to figure out which is which, we have to talk about unrecoverable costs. In personal finance, people love to compare a monthly rent payment directly to a monthly mortgage payment. That is a completely false equivalency. That's like comparing the price of a plane ticket to the cost of owning the airplane. Here's the reality. Your rent is the absolute maximum you will pay for housing in a given month. Your mortgage is the absolute minimum. When you buy a home, your mortgage is just the starting line. You also have property taxes, which run about 1 to 2% of the home's value every single year. You have insurance, you have HOA fees, and then you have the endless parade of maintenance and repairs. Landscaping, a new roof, a broken water heater, foundation issues. Imagine buying your dream house, and 3 months later, the roof starts leaking. Congratulations, you just bought a very expensive waterfall. Nobody posts that on Instagram. Home ownership is amazing until your furnace decides it wants an early retirement. Economists call these phantom costs or unrecoverable costs. And when interest rates hover around 6 or 7%, the math gets even more brutal. In the early years of a 30-year mortgage, roughly 80% of your monthly payment goes purely to interest. That is money paid straight to the bank. It does not build your equity, it is just gone. So the homeowner is actually throwing away money too. They are just doing it through different financial channels. If you use a popular financial heuristic called the 5% rule, the unrecoverable costs of owning a home, taxes, maintenance, and the cost of capital, average out to about 5% of the home's value every single year. If you buy a $500,000 house, you are throwing away $25,000 a year or over $2,000 a month on phantom costs. If you can rent a comparable home for $1,500 a month, the renter is actually throwing away less money than the homeowner. So why does the advice to always buy persist? Because real estate is hyper-local, and people forget that what works in Cleveland might bankrupt you in Seattle. This brings us to a crucial metric called the price-to-rent ratio. Think of it like the price-to-earnings ratio for the stock market, but for housing. You take the median home price in a city and divide it by the median annual rent. If the ratio is 15 or lower, buying is generally a much smarter financial move. The cost of homeownership is low relative to renting, and the forced savings of a mortgage will likely make you wealthier. You see this a lot in the Midwest and parts of the South. But if the ratio is 21 or higher, the math flips. In high-cost coastal markets like San Jose, California, the price-to-rent ratio is astronomical. Buying a home there might cost you $8,000 more per month than renting the exact same property. In a market like that, buying is a highly speculative bet on future appreciation. Mathematically, renting is a massive discount. Which brings us to the ultimate wealth equation that nobody uses. Imagine our two friends from the beginning. The homeowner puts down 20%, say $80,000, and every extra dollar they earn goes toward their mortgage, property taxes, and fixing the house. They have nothing left to invest. Now imagine the renter. They don't lock up $80,000 in a down payment. They invest that money immediately into a broad market index fund, like the S&P 500. And because their monthly housing costs are lower, they consistently invest the difference every single month. After 20 years, who wins? Historically, the stock market returns roughly 8 to 10% annually, while residential real estate appreciates at about 3 to 4%. Plus, the renter has liquidity. They aren't trapped in a single physical asset. If they get a great job offer across the country, they pack up and leave. They have opportunity equity. The homeowner has to list the house, pay 5 to 6% in agent commissions, maybe fix the place up and hope the market is hot.
If you sell a house before you hit the break-even horizon, you almost certainly lose money compared to renting. Nationally, that break-even point is about 6 years. If you plan to move in under 6 years, buying a house is usually a terrible financial decision. But wait, if renting and investing mathematically beats home ownership in so many scenarios, why does Federal Reserve data show that the average homeowner has a net worth roughly 40 times higher than the average renter? This is the plot twist. It is not because real estate is a magical superior asset class. It is driven by human psychology. A mortgage acts as a forced savings plan. Homeowners are legally required to pay their mortgage every month, which automatically builds equity. They have no choice. The problem with the renter's wealth equation is that most renters simply do not invest the difference. They save $500 a month by renting, and instead of putting it into an investment account, they spend it on vacations, restaurants, and a nicer car. They succumb to lifestyle inflation. Without strict investment discipline, renting becomes a wealth-depleting strategy. If you are renting, you need to turn investing the difference from a vague goal into a mathematically precise engine. Set up automatic transfers to your brokerage account the exact day your paycheck hits. The money must be swept out of your checking account before you ever have the chance to see it or spend it. Treat that investment transfer like a phantom mortgage. If your rent is $1,500, but a mortgage in your area would cost $2,500, categorize your housing cost as $2,500. If you fail to transfer that extra $1,000 into your investments, treat it with the same severity as defaulting on a real mortgage. If you don't have the discipline to do this, buy the house, because the bank will force you to save. But if you are disciplined, the math is entirely on your side. And be careful of new traps like build-to-rent communities. These are neighborhoods of brand new suburban homes built to be rented by corporate landlords. You get the yard and the pool with no maintenance, but the rent is incredibly high. You end up paying homeowner prices, getting renter equity, and making Wall Street investors rich. If the rent is so high that you have nothing left to invest, you are losing the game. Whether you rent or buy, the biggest mistake is spending too much on housing. Banks will approve you based on what you can technically afford on paper, not what you should afford. 6 months later, you are house rich and life poor. You can't travel, you can't invest, you can barely breathe financially. A house should support your life, not become your entire life. So who actually gets richer? The person who spends less than they earn. The person who lives below their means, avoids lifestyle inflation, and keeps their housing costs reasonable. Whether they rent or buy, that is the person who wins. Because wealth is not created by the deed to a house. It is created by hundreds of good financial decisions repeated over decades. A house can absolutely help build wealth, but it isn't a shortcut. And renting is not a financial failure, it is simply a tool. Like every tool, using the wrong one at the wrong time can cost you a fortune. Don't buy a house just because someone on the internet told you that is what successful people do. And don't rent forever simply because you are afraid of commitment. Choose the option that fits your income, your career flexibility, and your specific local market. Because the ultimate goal isn't to own a house. The goal is to own your financial future.